Good afternoon. From the floor of the CME, this is Chris Robinson, the Robinson Review, with today's comment on the grains. Well, I talk a lot about the USDA reports and how important they are, and lo and behold, that's really what we saw last week. And in 3 days, the report was on Monday, okay? But the Friday before the report, if you count Monday, Tuesday, Wednesday, Thursday, post-report, so in 4 days trading time, corn lost 56 cents. So, and you know, in 4 days, we pretty much took away a huge chunk of what were profitable prices for most producers. Most producers needed corn around 425 to 430. The high of the move back in June, mid-June, 472. Right? For a whole month, we were above $4.30 for a whole month. And the pivotal bit of information that changed everything from sort of a bullish market to back down where we're within 5 cents of the contract low, which we posted back in May 15th. That was really the USDA's acreage number and also yield number. So there's a lot of argument among farmers right now as to whether or not the yield is correct. Certainly the acreage number has been put to rest. It's very interesting that we had over 20 million acres, give it between corn, wheat, and beans and everything else, that went to prevent plant. In other words, those are acres that did not get planted. I think that if I had started the year out and said, hey, by July, we were going to have 20 million acres that went to prevent plant, you'd have been, oh my goodness, or how do I get long? We're going to the moon. And it's just a disconnect due to the carryout numbers. And it was very, very, very surprising to a lot of analysts who make estimates as to what they thought the carryout was going to be. So it always comes down to supply and demand. And unfortunately, for producers that did not hedge, because this is a year where, you know, the past 7 years we've been in a down market anyhow, bear market in corn. For the past 2.5 years, we were stuck in a 30, 35 cent trading range with not a lot of opportunity. We'd have literally 2 or 3 days during the growing season where a producer could have locked in, you know, at least on the board, profitable prices. So this year is going to be very, very painful for a lot of farmers if they look back kind of crying over spilt milk, because earlier this year when we were at 470, you know, we had that very wet spring. A lot of people thought we'd have corn with a 5 in front of it, if not a 6 in front of it. Instead here, you know, again, the high of the move is 472. We're all the way back down here to this 370 level. And that's about it. It's a cautionary tale for why producers, especially, because let's face it, a producer, you're nothing more than a net long speculator. You're always long. You always own it. So when the market gives you chances to either sell physical gain or to put a substitute sale on the market by setting a hedge, you really have to set a hedge. This was not a good year to sort of wait and see, wait and see, wait and see. Now, that being said, there's still a lot more to go for the rest of the year. It's only the middle of August. If we start getting yield reports which are sharply lower, you know, we could correct higher. A lot of people are still, they have not thrown in the towel, even though we've basically, you know, had a dollar sell-off. So there's still opportunity moving forward, but I just wanted to focus on that today. Corn alone. I mean, wheat and soybeans are kind of in their own pile, but I don't really have time to talk about it today. But certainly corn, you know, from a very bullish story. You got to remember, back in June, we were at 5-year highs, the highest prices we'd have in 5 years. And to have that disappear, you know, in basically, you know, 2 months, 2.5 months, pretty painful for producers, especially after, you know, it's been a tough 7-year slog. So how do you play it? Well, I would still sort of, you know, disaster put down underneath you in case there's another leg lower. It feels like the worst may be behind us, but you just never know in this market. Certainly if you are in a situation where you made good sales north of 450, 460, 440, this is a time where you can step in and say, all right, I think after a dollar break somewhere in the next 2, 3, 4 months, we could get a 20, 30, 40 cent rally. And certainly if I'm an end user, if I'm someone that would be hurt if prices went from 370 back to 470, well, here's your chance to hedge against that. So long story short, this was a year for corn where we really saw the benefits of having some sort of hedging program. If you didn't, there's still a lot of the year left. That's about it for today. If you're looking for help with your hedging and speculating, please look me up, Chris Robinson, the Robinson Review. Have a good rest of the week.